Inflation and higher interest rates have sent the stock market crashing back into the claws of a bear market, as we've been reporting. What does that mean for your money? Well, we're asking the expert here. Joining us now is local financial professional John Vandergriff from Blue Ridge Wealth Planners with more. Thank you so much.
Yeah.
So let's remind everybody what a bear market is.
Well, I think it can get confusing because we hear bears and bulls and we don't necessarily know which one's the bad one.
Right.
Because like in Tennessee, we like bears and,
We have to
bulls
think for
could
a
be
minute.
scary. You know, so a bear market is the negative side. So that's when you have a market event where it drops over 20% from recent highs. And so we need to know that and know that that is somewhat significant, but not rare historically. And we need to put that in context of obviously what's happening with people's money.
Peaks and valleys through the years, but what has investors worried right now?
Well, I think what has kind of led to this is interest rates. And as we talked about, the Fed announced that they were taking a more aggressive approach than what was expected based on last week's inflation numbers. Because I think, you know, we saw a little bit of relief last month, and then that number ticked upward again to new high territory. And so the Fed's job is trying to raise those interest rates to try to almost force a recession, you know, a tightening of the economy so that things will slow down. We'll get some relief on some of the things that we're spending. But whenever that first approach didn't take and start adding immediate relief, they had to get a little bit more aggressive, and it's one of those where eventually that will work. It's just how aggressive will they have to go, and what will that do to our economy?
Are we headed toward a recession then?
Well, again, you know, we talked about this. Recession is a very, you know, emotionally charged word.
Yes,
because
it
people
is.
think,
it's scary.
People think about 2008, you know, and so they hear that and they immediately jump there. A recession is just 2 quarters of negative growth, and even though that could be true, we still have some positive things that are going on. We're at record low unemployment. You know, wage growth is still happening. You know, compared to a year ago, we're up about 5.6%. Even though that's not where our inflation numbers are, it's a move in the right direction. And so we need to be reminded of some positive things when we look at how economic numbers work. And that doesn't always translate to people's fears and expectations with the stock market.
True, and I don't want to look at my 401k right now.
Yeah.
What do we do?
Well, I think the smart thing that's happening right now is really twofold. If you have already worked through with someone about a plan, making sure that you stick to that is really important, because when people get tempted to stick or take their money out of the market, it requires you being right twice, because you have to pull money out at the right time and get back in, and no one has been able to predict how to do that, you know, accurately. And so assessing your risk, if you've not ever had that conversation with somebody, now's a good time to just gauge where you want to be at, whether you're younger and you maybe need to take more risk. I read an article today that said when the market is down 20%, if you buy in at that time, on average, you can be up over 20% 12 months later.
Nice.
You know, so we need to know if we're further away, thinking long-term about our investments, but we really should be doing that anyway with any money that's in the stock market. And if we're not prepared to do that, maybe that's a sign that we need to be moving those things out. And
Have that plan.
Yeah, and I think if you've not had that conversation, that's going to help you avoid some of the emotions that you are feeling right now and the decisions that ultimately come from that, which don't usually end up being good. Yeah.
I know. Thank you so much.
Yeah.
We appreciate it as always. Elizabeth.